to another episode of the We Them Brothers podcast. I am one of your hosts, Jimmy Hicks.
They know. Stop doing this. It's 3 years in.
The other co-host, Anthony Rogerson.
I'm the lead. I'm not
the lead host, Anthony Rogerson.
Get it right.
As you can see.
That's our tech guy in the back. He's fired. IT.
Before we get started, we got to shout out our sponsor, Magic Mind. One of the world's foremost enhancement supplements as far as like for your brain, your mental. I've been taking it for a little bit. It does give me an energy boost, and it keeps me focused. And it's all like healthy ingredients, natural ingredients, so you don't have to worry about putting any harmful chemicals in your body. And getting that, seeing that infomercial later on down the line, like, have you or a loved one been exposed to
Camp Lejeune
right.
from the years 2024 to 2034?
Right.
You may have a settlement today.
No, but shout out to Magic Mind. Thank you for sponsoring us, and thank you for providing us with the supplements, because keeps us focused in this job that we definitely need to stay focused on.
So now, without further ado, Jimmy wanted to shoot this topic. I didn't want to shoot this topic.
The star is not in favor of this topic.
I'm not feeling it.
I think it's vital for the agents. This is going to be geared mostly towards real estate agents. This episode is going to be geared mostly towards realtors that, because we see posts all the time on Facebook and on Instagram. Who are your good lenders out there, or who has a good lender that they're using?
You don't even know what a good lender is.
Exactly. So we're going to tell you. Of course, like, we're good lenders. Like, we're phenomenal lenders, but we want you to know what questions to be asking to actually vet what a good lender is, because it's more than somebody just going to pick up the phone.
So we're going to give you the cheat sheet to underwrite, pun intended, your lender.
Yes.
Or you can just have them call Jimmy.
Basically.
It's all.
Because, I already know all the answers to these questions. So.
All right, so I got we got questions, and we're gonna get through this. We got a few.
Yeah, we're gonna skim through these and let y'all know like the best questions to ask your lender. Just to make sure that they're on top of everything and that they're servicing your clients to the best of their abilities. And if they're not, then send them our way.
No. Send them our way first.
Yeah, you're right. Send them our way first. This is for the people, like, if they've already messed up and sent it to somebody else, then it's never too late.
Send it to one of them hybrids, them hybrid lenders,
or send it to a credit union or Rocket Mortgage or somebody that you're never gonna get on the phone.
Shade, shots fired. So, all right. So, what would you be asking? Are these questions that the agent should be asking the buyer, or agents that they should be asking the lender? So, I have an agent. Yes. I'm an agent. I have a buyer. They did an application with you. Mm-hmm. The first question it should be, what is my buyer's credit score?
Well, yes. Or at least what range it's in. Because different credit scores are going to lead to different results depending on what programs you offer and everything. We personally go down to a 580 credit score, but that doesn't mean that your 580 is going to have the same process as a 640 or a 700.
Okay.
So it's good to know what your buyer's range is. If they have low credit, like if it's approvable but still low, then we may have some restrictions as far as debt to income ratio. The underwrite may be a little bit tougher. We may have to go through what's called a manual underwrite as opposed to an automated approval underwrite. So they may dig through the file with a little bit more of a fine-tooth comb. Or if we have like a 640, or like, let's go to a 700. If we have a 700 credit score, we pretty much are not only going to be able to qualify for most programs, if not all programs, but we're also going to get most likely close to, if not the best pricing for their interest rate.
That's like a premier, like your 5-star athlete.
Right, 700. Exactly. That's good. I like that. I mean, I'm just not here. 700 is the 5-star recruits.
5-star recruits.
Like the 640, 660 range, those are 4 stars. So like they still start. Like they may not be like, they wasn't the top, the creme de la creme of the recruiting class, but they still gonna start.
Yeah.
580 is a 3-star. Like we gonna get the minutes.
JUCO. 580 is JUCO. You gotta go junior college. You still go to college.
I would think credit repair is junior college.
No.
Or am I downplaying? My bad.
Credit repair is you gotta go get a job.
Intramurals.
Yeah. Credit repair. Yeah.
You got to walk on.
Yeah, so 580 is junior college, a little associate's degree.
Okay.
Get your weight up. Get all your prerequisites.
Okay. Yeah. And shout out to the junior colleges. We're not down to nobody. Like, get it how you live. You know what I'm saying?
There's a time and place for everybody.
Right. We get people in houses with 580 just like we do 700.
You just not playing in the SEC championship. You in the
might be in the MEAC.
You in one of them bowls they have at Georgia State.
The AAC.
Yeah. Something like that. You
Sunbelt.
Still playing.
Sunbelt Conference.
You know, you sharing a locker room with other teams.
Hey, it's been some Cinderella stories.
That's all I'm saying.
We're getting off topic.
No, we're not. We're making this topic interesting.
But yes, 580 or better works. It's still, like I said, it's approvable. May not be easy, but it can be done. 640 qualifies for most programs. I think it qualifies for conventional FHA, VA, and USDA. Now, with that being said, because I get this a lot too, with somebody that has, let's say, a 640 or 660 credit score, they may go out and they'll find a property like a condo or something that has to go. We've already pre-qualified them for FHA, but they may find a property that can only go conventional for whatever reason. So your question usually is, well, can they switch to conventional? And the short answer is yes, but it's a but in there.
You got some money.
Right. Like you may need a higher down payment if you're switching to conventional versus FHA with a lower credit score. You're most likely going to have a more expensive interest rate at a 640 with conventional versus FHA. There may be some more debt to income rate. Well, there will be some debt to income ratio restrictions as far as you may qualify for both, but you may not qualify for as much. Like you may qualify for 350 with FHA at a 640 and may only qualify for 290 to 300 with conventional at a 640.
Mm-hmm.
So these are things to know as far as like when you're navigating and answering those questions, because we all know, like especially with the market, how it is now and how we anticipate it'll be as rates continue to fall. You may go into it thinking like, okay, I'm gonna buy this house in this price range under FHA. And then when you get out and start looking, they may fall in love with a condo or a townhome that, for whatever reason, they're not letting it go FHA, or a seller, that just doesn't want to deal with FHA for whatever reason. They would rather go conventional. So you want to have that flexibility to be able to switch programs if the time comes. This is important to know if you need to switch, or if you're able to switch programs, or if you need to keep looking and make sure that your buyer can go FHA regardless.
All right. And the 700, we already talked about that. That's the gold standard.
Yeah, 700 and up is gold. We shouldn't have a problem getting you approved. We shouldn't have a problem getting you a good interest rate, or the best pricing that would be available for your interest rate.
The gold standard of pricing.
Yes. Yeah. And down payment assistance programs, especially Georgia Dream, are easier to get into with a 700 credit score. Like they have a threshold where 640 gets your foot in the door, but at a 700 with Georgia Dream, you can qualify for the max that FHA will allow. So there's no restrictions in it that way. What about the difference between being approved via automated underwriting or having to go through a manual underwriting?
Well, the main difference is not all lenders do manual underwriting.
That is true.
So if we start there, a manual underwriting just has a little bit more rigid guidelines.
Yes.
To an automated underwriting. The loan will still, we can still get the loan approved, but not everyone does manual underwriting. There's different guidelines as it relates to manual underwriting. You have to have, I would describe them as stronger compensating factors.
Yes.
In order to get a loan.
So it has to make sense, basically. Like we know that people go through things, and there may be something that hits your credit where you've been able to get it back up to that 580, 600 threshold, but you haven't made it to the 700, obviously. Doesn't disqualify you from getting the house. It just means that we have to pretty much show the underwriters that you're still a strong candidate despite your lower credit score. So a lot of compensating factors include having money in the bank for reserves. Mm-hmm. Reserves meaning that this is money that you have, like even after you send your down payment and closing costs, you show that you have 1 month, 2 months, 3 months worth of the monthly payment of the house that you're trying to buy. I've seen compensating factors where we have to show other trade lines that are in good standing that may not show up on the credit report, such as utilities, such as rental verification. So we have to show that your rental history has been good for the last 12 months. You haven't been evicted. You haven't gone late on anything, things like that. They check the items that are on your credit report, Make sure that you don't have any lates in the past 12 to 24 months, depending on the situation. So, like I said before, like just going through the file with more of a fine tooth comb than maybe an automated approval. Automated approval, we don't have to have your rental verification. We may not need reserves depending on what the desktop underwriter says. So it's just things that like one is easier than the other, basically.
Easier for you, easier for the buyer.
Easier for the buyer,
not easier for us because
we're gonna work it regardless.
We're masterful at both.
Yeah, we're gonna work it regardless.
Right.
But easier for your buyer, and because I know everybody's also kind of penny pinching, as far as making sure that you have your down payment and closing costs. Now is still a good time to buy to get seller incentives, so you won't have to come up with everything yourself. But yeah, like that's just something to think about, like something to ask your agent, or for your agent to ask the lender to make sure that all your ducks are in a row, and make sure that your earnest money is still protected. Because if you put somebody under contract and we know that they got to have 3 months reserves, but some bills came up and now they only have 2 months reserves.
Right.
Now we got to figure some stuff out. Like how can we work the numbers to where they're still going to have their 3 months? So it's a lot of different factors depending on how your underwrite goes.
All right. Question number 3 on today's episode of Ask Jimmy. What is my buyer's debt to income ratio? What are my buyer's DTI limits for the loan program they are using? How tight is the ratio, and do you see anything that could cause an increase or decrease to... How tight is the ratio, and do you see anything that could cause it to increase or decrease?
That is a good question. Very good question, because a lot of factors go into that, as far as we may qualify for somebody. Let's say we qualify somebody at $300,000, and their debt to income ratio, just FYI, the max debt to income ratio you can go up to for FHA, for example, is 56.99. So let's say we've maxed out everything on your buyer, and at $300,000, the buyer is at 56.8. Let's say that. We know that things can get tricky at 56.8. So at that $300,000, you may even want to look at a little bit lower to give yourself some cushion. What I mean by that is, let's say if you find a home for $300,000 with an HOA. That HOA, depending on how much it is usually, unless you tell us up front, that's usually a number that we're not calculating into your debt to income ratio up top. Once you go into contract and we find like, oh, this community has $100 a month HOA, well, that adds $100 a month towards your monthly payment, which could throw off your debt to income ratio. Same thing with taxes. If we calculate that you may be at, let's say, 1% of the sales price for your taxes, but you move into a community, Fulton County, for example, that has both county and city taxes. So the taxes may be higher. Now, that also will alter your monthly payment, which alters your debt to income ratio. So it's good to know, like, okay, because a lot of realtors will ask, well, what is their max? Like, we may qualify them based off of where they want to, where they want to be monthly payment wise. But once they get out and start looking at stuff, they may be willing to go up on their monthly payment just to get the house that they want.
The house that they can afford, or
right.
Yeah. So let me ask you this: when an agent sends you a buyer, you're working with the buyer, and you're going to give a pre-approval, what? And let's just say it's FHA that goes up to 56.99.
Mm-hmm.
What amount do you run your DTI up to? Do you run it all the way up to 56.99, or do you leave yourself some room for error?
Me personally,
room for variance.
Yes, me personally, I leave room for variance. For one, there's several reasons why I try to leave room for variance. To leave room for that HOA, depends, especially if I know somebody that may not be moving into a single family subdivision, but maybe looking at condos and townhomes, because we know that the HOA on those are typically higher. Leave room for the taxes, because we don't know what county and what city that they're buying in.
Mm-hmm.
So they may have been looking in DeKalb at first, now they're looking in Clayton or looking in Gwinnett, and the taxes may be lower or higher depending on where they're looking at. So you want to leave room for that. Also leave room for their income calculation. A lot of people will tell us that they work 40 hours a week and this is what they get paid per hour. and we start getting pay stubs in and see you only work 38 hours a week. We can still count that income, but it's not going to be as much as we thought it was. So that also is going to alter the debt to income ratio.
So what's your comfort on at first look? Where won't you typically go over on your pre-approval or your desktop underwriting run? I usually try to stay below 54 to 55.
That's about right. I usually try to stay no more than 55, I would say, because that like $100, $150 here or there, depending on what price range you are, that shouldn't take us over the 56.9 if we stay in or go in at 55. But yeah, I would say between 54 and 55% is probably where you want to have that wiggle room. Or, for example, let's say is another case. If we're rolling in closing costs, if the home overappraises and we're rolling in closing costs, rolling in those closing costs is going to take your monthly payment up slightly. It should save you thousands of dollars out of pocket, but it may take your monthly payment up a few dollars. If we're at 56.99 starting out, that doesn't leave ourselves any room to be able to roll in closing costs.
Right.
Speaking of which, we should mention that not all lenders are able to go up to 56.9. There's a lot of lenders out there that they only go up to 53 or 54, or some even only go up to 50.
Right.
So that's when...
Not us.
No. We go we know what Fannie Mae and Freddie Mac and HUD will allow, what VA will allow, what USDA will allow. So we don't have any overlays as far as that's concerned. So we can go up to whatever those actual entities will allow. So we don't have a company that's being a little bit extra conservative, for lack of a better term.
Right. We were extra aggressive.
Yeah. So that's a good thing to know. That's also a good thing. I don't even know if it's on here, but that's a good thing to also ask your lender. Are you able? What debt to income ratios are you able to go up to?
Right.
Because most lenders will just tell you oh, this is the max that they'll qualify for, and not give you any context after that.
I should have led with this. Don't be out here asking these questions just to try to sound smart.
No.
Have some context with the questions, because this would be well, what do you go up to? What's your DTI max? It's what? Simmer down.
Right.
Simmer down.
Because any decent loan officer can spit that right back at you, and then you just be twisting the wind, and you won't you would have asked a smart question, but still don't know how to receive that answer.
I go up to 80% DTI, and you're okay, that sounds great. It's
nobody does that.
That is that doesn't sound great.
That is a recipe for another housing crash.
That sounds that you were lied to. Okay, I just wanted to put that out there. Have some context to your questions.
Right.
Next question: what is my buyer's interest rate that you pre-approved them with? Is this rate still available? Is the rate locked? Why or why not?
So typically, your rate is not locked in until you actually go into contract for a home. This is important, especially now with the ever-changing market where rates are fluctuating. We're anticipating them to start going down. Hopefully this week, we may start hearing some more numbers about cuts. Yeah, I mean we'll be back to y'all. You got a Fed meeting this week, but
I might be next episode. I might be pivoting. I might have a whole pivot.
I mean, I was about to say we have a Fed meeting this week, so
I'm going higher, longer.
Higher, longer. Really?
Another episode. Can't give you all that right now. I know people down at the Feds. I know people down at the Feds. At the Feds. Plural. Inside joke.
But that's just something to be aware of as far as when we're able to lock, because let's say if we qualify you today and you want to go with the cheapest rate of 7.125. If we don't have a property under contract, and let's say you go a month without finding something, now you finally find something. But that 7.125 wasn't locked in before. Now we're at 7.5.
Right.
That may alter a lot of stuff. That could alter your debt to income ratio. That could altering that debt to income ratio may be the difference between an automated approval or a manual underwrite. So it's always good to stay abreast of where the interest rates are, and just know that you're really not locked in until you have a property under contract, and we can lock in on that specific property.
Correct.
Also, it's good to know if you're locked in on a property and let's say you don't go through with that property, you cancel the contract for whatever reason. That lock doesn't follow you.
It follows the property.
It follows the property. So we would have to do a different lock under a different property. Now we're hopeful that as we get further and further into the year, those rates come down and it improves everybody's situation. But
higher, longer.
We don't know for sure. So
you know for sure. I just said it, and I'm for sure. Higher, longer.
I mean, I would say that you're very good at keeping up with market trends and what to anticipate.
Hey, that's what I'm talking. Now we kicking this episode into gear.
So I would definitely lean towards Anthony's
leave what I'm very good at. I like it. No, but we'll talk about that. I think that's a whole market discussion.
Yes. So we have to answer the question. We always pre-approve based on where the markets are that day or where the market is that day.
Yes.
There's not a lot of most times there's not a lot of drastic movement day to day. It just depends on what's going on in the market. And the rates don't necessarily change. Like I heard something. The rates went down today. Rates themselves might not have went down today. Rates might have gotten cheaper.
Right.
So we might be at a
cost to the rate.
Right. So we might still be in the sevens, but the cost of that 7.125 may be $1,000 cheaper today than it was yesterday, or $1,000 more today than it was yesterday, just depending on the situation.
Right. All right. Next, number 6. How many seller paid closing costs are required to get this deal closed? What amount of seller pays do you include in my buyer's cash to close? I want to answer that.
Go ahead.
How many seller paid closing costs are required to get as much as you can get?
All of them. Exactly. That was going to be my answer. All of them.
Get as much seller paid closing costs as you can get. Every penny that you get for your seller or you as a seller, every penny that you get for your buyer or you as the buyer that you get from the seller is the penny less you have to come out of your pocket with.
Exactly. And we can use that in a myriad of ways. Like we can use that to buy your rate down. Let's say if you have the money, let's say your buyer has all the money, they don't need closing costs. Unless you're using that to win the deal, which I feel like in this market you shouldn't have to, you still ask for the max or as much as the seller is willing to give. The max that the seller can contribute on FHA is 6%. The max on conventional depends on the amount of down payment, but typically if you're doing 3 to 5% down, it's 3% that they can give. And the max.
Well, we have some creative ways to get around that too.
Yes.
So we won't say max. The typical amount.
Yes. Same with VA.
Here at North Star.
Right. We have some creative ways to get around it for VA too, because it's 4%, but it's 4%. It's closing costs plus 4%. So they can, on a VA loan, the seller can potentially pay all of the closing costs, and we would still have 4% more that they could contribute towards that or past that. So we can use that, like I said, to buy down the interest rate, pay off things at closing. So the more you get, the less money out of pocket that your buyer is going to have to spend.
Right.
And they can save that money for, instead of doing rent-to-own furniture, they can buy furniture.
Right. Second part of that, what amount of seller pays did you include in my buyer's cash to close? Quote. What amount do you typically include seller pays in your quotes?
No. And the reason that I do that is because I always want my clients to see the full cost of everything. But I let them know, like, this is the full cost, because your cash to close is going to be your down payment, your closing costs, which is your lender fees, prepaids, and your taxes and insurance, and the attorney fees, and the cost of the interest rate. So all of that is rolled into one number, and that gives you your total cash to close. Now, from that number, we can subtract your earnest money. We subtract the seller contribution. If there's any lender credits available, we subtract that. If you're doing any down payment assistance, we subtract that from that number. So after all those credits are subtracted, then that's where you get the physical cash to close that you would have to bring to closing. I like to start off with no credits. So not only does that help the buyer to see the full cost of everything, it also helps the agent better negotiate for seller pays because, okay, I know that I just saw that, for example, the total cost of everything is $20,000. I know my buyer only has $16,000 in the bank. So I know I need to negotiate for at least $4,000,
right,
if not more, for to make everything work for my buyer. So that's why I like to do it with no closing costs up front, or no credits up front, so you can see everything.
Gotcha. All right. Number 7. Does My buyer's income look good. Anything? No.
This is a loaded question.
No, looks terrible.
So typically, if we have somebody with a W-2 income and they work 40 hours a week, we have pay stubs. We can guarantee that they work 40 hours a week. Or somebody that is on fixed income, so Social Security, disability, pension, things like that. That income is easy to verify. So like we have pay stubs or we have awards letters, so we know exactly, even before it gets to underwriting most times, unless you work variable hours, like we know how much income we can count. With our self-employed buyers, it gets a little tricky because we have to use tax returns. So it's based on what you filed on your taxes for the past 2 years after write-offs. So we have a lot of self-employed people that they may have made tons of money over the year, but they wrote it down to a certain amount because they didn't want to pay Uncle Sam a large tax bill, which is fine.
And I understand we are not the Uncle Sam police.
Right. Yeah, we're not the IRS police. So all we need taxes for is to verify what your income is based on the guidelines that we have to go by. We have to verify what your income, like what income we can count based on your self-employedness. I see people all the time that they made $300,000 last year and they wrote it down to 40. Well, now you can qualify on a house based on that
making
$40,000
a year.
Right. Now, like you said, we always got some tricks up our sleeve, so we know how to look at tax returns, how to maximize them, what sections we can count from your write-offs to count back into your income to like maximize how much you're able to buy while keeping your tax bill low. Basically, as far as you can still write that stuff off, is depending on what sections you put it in. We may still be able to maximize your income based off of that. So that is a tricky question. Like you can't just say like, does my buyer's income look good? Like, well, I see they're making money. Right. It just depends on what type of money that they're making.
And is that money reported?
Right, exactly. Like debt to income ratio is how we find out how much somebody can qualify for. So it's self-explanatory. It's the monthly debt versus monthly income. So depending on how much monthly income we have to count and how much debt we have to count, because we know student loans is a big deal. We know how to kind of get around those or limit the debts on those. One thing is kind of harder to limit the debts on is car payments. So I see a lot of $800, $900, $1,000 a month cars out here.
You living in your house.
Yep. You are driving around your house payment. So think about that. Like if you think like, well, I'm gonna get my car first and then I'm gonna no. Do not go out and get your car first. Finance this house and then see how much money you have left over to get that car.
Correct. What's next? Has the appraisal been ordered? What is the due date?
Yes. So we actually have some fun tools on our side that alerts our agents when the appraisal's been ordered. It gives you a due date. It lets you know when the appraisals come back and everything. So we don't necessarily even have to tell you when it comes back, but that's still something important to know because usually that's worked in the contract as far as like the finance contingency, appraisal contingency. So you want to make sure that your lender is not sleeping on getting the appraisal, title ordered, all that stuff.
So what I would say to that, and this is just everyone doesn't do it this way. I always wait for, I typically, unless we're under the gun, I typically wait for the inspection to come back before I order the appraisal.
Yes.
Because most times when the inspection comes back, that's when you're going to make a decision if you're going to move forward.
Right.
Now, if we receive this contract and at the receipt of the contract, we just go out and order the appraisal and your client pays for that appraisal, and then you get your inspection done and you decide you're not going to move forward, you're not going to get that appraisal money back.
Right.
So I kind of lean on you as the realtor to say, hey, we had the inspection and we're ready to move forward. Please order the appraisal. Now, it doesn't have to be done that way. That's just my preference in trying to provide you and your client the top-notch service and save them some money.
Right. Which also goes back to how you negotiate the contracts too, as far as putting a due diligence period in there and making sure that we have ample time to get an appraisal.
Correct.
Based on that appraisal contingency. Because if you're putting everything in 3 days and 7 days, you're kind of forcing our hand to need to order everything right off the bat.
Forcing their hand.
Well, yeah.
Yeah. So, what is the due date? Or you'll get all that information. Number 9. Has the loan been submitted to underwriting? If again, these are questions that you should be asking your lender.
Yes.
Has the loan been submitted to underwriting? If not, when? What are your turnaround times?
Yes. So outside of like super busy seasons, underwriting turn times are typically 2 to 3 business days, especially during the first underwrite. Now, here at North Star, we like to submit our files to underwriting even before we're under contract. That way, not only do we figure out any kinks that we got to work out before you go put down earnest money and pay for an appraisal and all that good stuff, we also cut down on the turn time on the back end. Mm-hmm. So as long as we get, like, if we can get income, assets, credit, all of that underwritten up front, then not only does that make for a smoother process, but it also makes for a quicker process. Because like we said before, sometimes more money may not win that deal. Sometimes speed may win that deal.
Speed win it. So the language that's used is, do you guys pre-underwrite?
Yes.
So yes,
we do.
We underwrite on a TBD basis. So there's two parts to underwriting. There's the underwriting of the buyer and there's the underwriting of the property. Mm-hmm. We can underwrite as long as your buyer or you as a buyer, you get your documents into us ASAP. We can underwrite you so that way we've gotten that part out of the process. So now when there's a multiple offer situation and you got to move expeditiously.
Right.
You can do that because we've already underwritten you, and all we have to do is underwrite the process. And the question then is posed to us: how long does it take you to close? Well, we can close really quickly as soon as we get the title back.
Yep.
And the appraisal. And if we rush those things, I don't know if you can rush a title, but you can definitely rush an appraisal. Mm-hmm. You can get an appraisal back tomorrow, or you can order it today, rush it, and get it back tomorrow for a fee, of course.
Yes.
So why it's important to underwrite the buyer as soon as possible is because you get all that heavy lifting out the way, and now when you find your property, it's much easier for you just to put in an offer and say, "Hey, my lender can close in 7 days."
Yep. So all we need is a title, clean title, and appraisal,
and we're moving on.
Yep.
So that's answers that question.
Are there any underwriting conditions that will be difficult?
Yes. I had someone ask me that question today, in fact. And what I said was, now there's your typical things that you turn into underwriting, which are your driver's license, your W-2, your pay stubs, all of the foundational things. But right. Each underwriting is like a snowflake.
Right.
None of them are the same. So there could be underwriting conditions that come back, and they're very simplistic, right? They're 1, 2, 3. However, there may be some underwriting conditions that come back that may be a little bit more challenging. You know, something that's related to tax returns, things mm-hmm. that you have to wait for another entity to send you versus something that you have already. So I would describe a condition being difficult if the buyer has to go out and get that condition from another entity.
Right.
Something like a child support decree.
Right.
Right. Oh, we see that there's child support, and we need to get the marriage decree. Or we need to get the child support decree, and now that comes from the county in another state.
Right.
Right. So something like that would be difficult versus I need an updated bank statement. That's not difficult.
Right. You can go to your bank or you go
online and do that.
Right.
So it all depends on
proof of IRS payment.
Right.
Like that's something you got to deal with the IRS to get it.
Right.
So we all know how hard it is to get somebody on the phone or get IRS to send you something right away. Right.
So whenever there's a document that you have to get from another entity, that would make it more difficult than something that you would already have in your possession.
Yes. So, I'll also add to that. We have a saying, sometimes conditions create more conditions. So there may be some things out there, like if you're asking us this up front, it may be some things that underwriting is going to ask about that we don't even know yet that they're going to ask for.
Right.
So depending on if you turn in something and it causes underwriting to ask another question or request another statement for verification, for example, that's something that we didn't know, because I hear it all the time, like, well, why didn't underwriting ask us this up front? Well, we didn't know we needed it until you turned in XYZ, or we got something from Fraud Guard or something from the title company or whatever.
Right.
Now we know that we need this information.
Right.
And it causes a difficult condition to be requested.
Right.
So it just depends on the situation.
And everyone's situation is different.
Exactly.
When are you expecting the clear to close?
It's a good question. did you turn in everything on time? Did you like give us everything that we asked for? Did you take 2 and 3 days because you were fighting like, well, why do y'all need that? Or like you send us half a page or something was cut off, or you send us 2 pages off an 8-page document that we needed all 8 pages of.
Right.
So a lot of times the expectation on not only underwriting but getting the clear to close depends on how much full documentation the buyer is giving us. Sometimes it depends on how much full documentation the agent is giving us.
Correct.
Because for some
we
reason
might need an amendment.
And
we're waiting on this amendment slowing us up.
Yep. We have agents that they're slow to get amendments through. They may hold amendments off of the contract for whatever reason, and then they give it to us last minute. And now we see something like, oh, well, we're going to need 1, 2, 3, 4 of these items too.
Right.
Because of the amendment that you just gave us.
Right.
So it depends. If we have everything and we can't foresee anything having or anything like coming up based on the stuff that we've already gotten cleared, then it's still the normal 2 to 3 day turnaround time, depending on the situation, depending on what underwriting turn times are. But that just goes back to making sure that whatever we're asking for, get it to us in full.
Get it in full.
And confirming that we have it. So, yeah.
All right. We got the clear to close. Everything looks great. Next step is getting the package to the closing attorney. Ask your lender, has the package gone out?
Yes.
Yes.
Once we get our clear to close, we're really good about getting the closing package out. Typically an hour or so after we get our clear to close. Like I've been seeing like closing packages go out, like the closer hop right in after we get our clear to close and send it right out. So we usually don't have any issues with that. As long as we have, and this goes back to y'all picking a good closing attorney too. As long as we have good communication between our closer and the closing attorney, package will go out, they'll match numbers, and package will go out without a hitch. And everybody, like the documents will be waiting for everybody to sign the closing. So that's why we like to have our clear to closes like a few days before. That way, like
closing date?
Before the actual closing date. We have done it where we've gotten our clear to close and sent our closing package out same day. But typically we don't like to do that. Right. Not just for us, but for the buyer and the agent.
All parties involved.
Right, because we want as seamless a transaction as possible. But yeah, like our closing department works really well with us. Another thing you might want to ask is, as far as these departments, the closing department, the underwriters, is all this stuff in-house?
That's very important.
Yeah, because a lot of, like, we know our underwriters. We work well with our underwriters. They're all working for North Star. Our closing department is working with North Star or for North Star. So we don't have to worry about going outside and getting another third party involved in the transaction and possibly elongating that turnaround time.
Of course. Yeah. But I'm sorry.
Hey, yo.
That was wild. Elongating that turnaround time was wild. Sorry. But no, so those are some questions that you should be asking your lender. Just one, to empower yourself with information. Just know, like, you know, we're getting to the time. We'll talk about this on a future episode. What this market has done in terms of washing out some loan officers, washing out some realtors, and the best of the best will be the ones that are like still standing.
Exactly.
So
it's not for the weak.
It's not for the weak. We'll be back next week. Speaking of week, I'm also weak because I'm hungry.
It's
gotta
time
eat.
for lunch. Yeah, it's time.
Gotta go eat lunch.
Yeah.
Hit us up. Ask us questions. I'm Anthony Rogerson.
I'm Jimmy Hicks.
Collectively.
Oh, that was mine. That was me. We are them brothers.
The lob, and he's just like, "Oh, I'm supposed to catch the
My
lob."
fault.
That's what Mello was like. Oh, that was from me, champ. Thanks for having the vote of confidence. Remember that? He was the throwing throws. It's like, "Oh, that was from me, champ."
All right, peace.